Stock markets have certainly become more volatile these days, thanks to fears of a slowdown in global growth brought on by a slide in Chinese stocks after China's devaluation of its currency. Prior to that, Greece was making headlines due to its need for a restructuring of its bailout. Add to that the decline in oil prices, signs of strength in the US economy, and the associated expectations that the US Federal Reserve will move to gradually raise interest rates, and you have a recipe for bigger swings in the stock market. It is these dramatic market movements that make many investors question their investment strategy. They fear that the stock portion of their portfolio will continue to decline rapidly, and this fear causes them to sell or reduce their stock exposure at a time when they shouldn't, thus hurting their long-term investment performance.
So here are a few recommendations we have that can help you achieve better results in a volatile market. First, have a strategy. Your time horizon, goals, and tolerance for risk are all key factors in helping make sure that you have an investment strategy that works for you. The shorter your time horizon or the lower your tolerance to risk, the more conservative your portfolio should be.
Second, be comfortable with your investments. Understand that stock markets do not go up in a straight line. Markets go up and down every single day. In fact, market corrections happen frequently, as you can see from this chart. If you are nervous when the market goes down, you may not be in the right investments.
Even if your time horizon is long enough to warrant having a more aggressive portfolio, you have to be comfortable with the short-term ups and downs you'll experience. It's important to find the right asset allocation to help you achieve your financial goals in the time frame you set.
Next, be sure to diversify. Never put all of your eggs in one basket. One of the smartest things you can do to help manage the risk of volatile markets is to diversify. While it won't guarantee you won't have losses, it can help to reduce them. Make sure your investment strategy gives you exposure to different asset classes such as cash, bonds, real estate, and equities. You can further diversify by geography, having money invested in Canadian, US, and international markets. And you can also diversify by investment style, growth versus value, small cap versus large cap.
Whatever you do not try to time the market. The most successful investors are those that make a habit of investing in quality companies and owning them for the long term. It is impossible to time the market accurately on a regular basis. You have to be right twice. You have to get out at the right time and then get back in at the right time. This is impossible to do consistently. Attempting to move in and out of the markets can be costly, as seen in the chart of how $10,000 invested in the S&P 500 would have grown between January of 1980 until March of 2015. If you stayed fully invested that whole time period, your $10,000 would have grown to over $500,000.
However, if you had missed just the best 10 days of the markets in that 35-year period, your portfolio would only be worth $232,000. Missing the best 50 days would have resulted in a portfolio of just over $41,000. This chart perfectly illustrates the benefits of staying fully invested and not getting caught up in the day-to-day noise of the markets.
Finally, dollar cost average. If you invest on a regular basis, such as weekly or monthly, you can actually benefit from a volatile market. For more on dollar cost averaging, you can refer to our video on dollar cost averaging on YouTube.
So that's all for now. Be sure to follow us on our Facebook page for regular updates. Thanks for stopping by, and we'll talk soon.